number of claims. I just updated the number for today. In the 22 weeks since we started with the pandemic and the shutdown, from March 21st to August 15th, Texas has lost around, people have filed for unemployment, around 3 million people have filed for unemployment. So you can see right away that big spike in increase. You saw that decrease. Well, what's happening in that right now is that we saw some spikes in weekly unemployment claims, and that was basically due because of the number of COVID-19 cases. That would be the red line right there. So it's interesting, to all of you, I never thought I was going to actually start looking at COVID or follow health numbers or cases of people being sick, right? It's interesting. I'm an international applied economist, and I've never thought that I would be following this. But this one of the things that has changed COVID-19 is that we're looking at other things that we did in previously, right? As economists. So the unemployment rate is, see the effects. You can see right away how the unemployment rate, the effect. Initially, Texas had a higher unemployment rate than the U.S., and then we see the decrease going forward of the unemployment rate all the way to June 20th, below the U.S. Of course, why? One of the reasons is because the Texas economy opened first than the rest of the other parts of the U.S. economy. Now, the impact. We've seen this, right? Who has been hurt the most? It precisely has been the services jobs, the leisure and hospitality jobs. Those are one of the sectors that's lost a lot of jobs. Again, also other services, specifically the waste management services. Those are the ones that have impacted. And in the case of Texas, as Bruce mentioned, the downturn in the oil industry has affected the oil sector here in the state and nationally and internationally, right? Oops, sorry. So what are we going to talk about Texas without any oil data? And here's some production of oil. You can see right away how the production of oil here in the state of Texas has decreased. Also, the number of operating rigs, especially it accelerated due to the COVID-19 pandemic. Now, again, the price of oil, it basically went all the way down to almost to $14 a barrel, $50 a barrel. Now it's jumped back to $40. Natural gas prices continue to go down. So that's been a double whammy for the Texas economy, right? Besides the COVID-19 pandemic, also the downturn in the oil industry. Now, again, here's the issue. The road to recovery depends on health outcomes. These are the total cases in Texas, 5 million in Texas and its 4 major MSAs. And the good news is the daily new cases, as there's a downward trend after the month of July. Hopefully this continues because this is going to affect the path to recovery for the Texas economy and also for the U.S. economy and other parts of the country. So a lot of things were discussed, right, when this happened. What's going to be the new normals, right? What are the new normals in real estate and the economy? So before I start talking about that, think about it this way. We're economists. The longer the crisis persists, we're more likely to see transformative, lasting changes in behavior. It's really difficult, if you look at it through history, to change behavior if it has a short-run impact. Structural change takes time. What we saw, right, what we're seeing, what the actual effects of COVID-19 has been actually an acceleration of the changes already prevalent before even the pandemic hit. Example, working from home, online purchases, e-commerce, the boom of that, right? Physical retail has been affected by that. Again, healthy lifestyle benefits, right? The idea of being healthy, eating healthy, not having preconditions have helped those people, have benefited those people during the pandemic. Also, this is important also, right? Education, skill attainment outcomes. Those are really have also that, we've seen that even before the pandemic. Who's been doing well in the economy, in the 21st economy? We've seen that bridge between income inequality increasing. And one of the culprits has been that, people with higher skill or education have done better. And during the pandemic, we've seen that. who's been able to work from home? Who's been able to do that has been people that have higher skills, work in tech, or other services that allow you to work from home, right? Versus, again, leisure and hospitality, where the skill level is lower, and you have to work. You actually have to be in the workplace. Now, I mentioned this residential. What have been the impacts on residential of the pandemic? People that have been hurt the most are low skill, low wage. Majority of people work in service industries, but the majority of them are renters who can't afford to buy houses. We definitely lost some first-time home buyers. Somebody was going to make that transition from renting to home buying, especially if you're working in those sectors. Another trend that we saw before the pandemic hit us was the housing supply. We had issues with housing supply even before the pandemic, right? And that's going to continue, especially for single family homes at the lower price cohorts or starter homes. That is one issue that's actually accelerated this process. Again, I think the preference of the pandemic supported the purchase a home, a single family home. Now, major issue going forward, and a lot of people are talking about this, right? About 1/3 of the country's renters were protected by an eviction moratorium that covered properties with federal insured mortgages. All these federal programs ended. This one expired July 25th. Until now, the Multifamily Association, the rent payment trackers, says about 87% of apartment households still paid their rent up to August 13th. That's a good number. And we tracked this number. If you track this number, it was interesting to see that it never actually fell, but that was because of the benefits of the federal programs that helped a lot of people that lost their jobs. So, and also some cities and landlords offer temporary rent reduction and repayment plans. So again, another issue also is the many renters that are jobless now and depend on the supplemental weekly unemployment benefits, $600. That also expired July 31st. So here's the issue for the multifamily sector. The number of tenants able to pay rent going forward is unknown because it's going to depend on them being employed and earning wages. Now, currently, if you look at the data, the JOLTS data, I think there's about 5 million jobs available, open, and you have like 60 million people unemployed. So you have like ratio of 3 people applying for 1 job. So that's a major issue, of course, going forward. So again, but still, people still need a place to live. Income constraints do play a role, right? That's really important. It doesn't allow them housing affordability to purchase a home, right? So the supply of this would be the case of multifamily also could be affected in the short run, right? But the massive migration that people talked about initially, it was not going to happen out of apartments, right? There can be some residual effects about the future of clustering and future apartment demand. But again, people still need a place to live, and you have that income constraint, right? Housing affordability issues help demand, right? For multifamily, for apartments. Not everybody has the income to purchase a home. You have to live somewhere. So some trends that we see in the long run, you can expect more amenities, less density, maybe better communal spaces, storage units, fewer than 40 apartments for development. The trend toward mixed-use commercial, which include office, retail, and multifamily, should continue because why? They offer quality amenities, less density, and often in suburbs and urban fringe. We're still with the city vibe, right? That you can go down from your apartment to your work, you can walk there, or to the restaurant. Everything's close by. Now, commercial real estate. There's a strong relationship basically between commercial real estate vacancies and employment. The longer the employment rate lasts, the stronger the impact will be, right? So in a minute, I'm going to talk about this. I'm going to show you graphs. And you can see right away, the first thing you would expect was for vacancy rates to increase, and they did increase, right? Now, this is another process we saw pre-COVID-19, was the accelerated retail restructuring, development of industrial warehousing. Physical retail was hit the hardest, accelerating the shift to e-commerce, right? As we were shut down in our homes. So industrial warehousing was less affected. Why? Because of the shift to e-commerce and the need for distributive and warehousing centers to supply all these goods and services we were purchasing online. Now, again, office, the new normal. Initially, everybody was talking about, oh my God, everybody's going to work from home now. And, well, not everybody can work from home, right? And we've seen the effects of working from home also. If you see current surveys, there's a lot of surveys pointing towards the idea of people going back to their offices and want to work in their office. I think what the people are going to miss or want now is more like a hybrid or the flexibility of going to your office and maybe working from home sometime, right? Now, what is the future of office building? We've seen cases in history, right? We saw SARS, Hong Kong, and now a pandemic. Did not have a real impact on office buildings. We also, when September 11th, New York City, a lot of people thought that there was going to be a mass migration from New York out of New York. What is actually happening in those cities is more about taxes and incentives, right? Regulation is forcing people to move from New York or California to Texas, as an example, right? Or Nashville. Again, some of the amenities cannot be duplicated at home, right? The relationship, the networking building, it's difficult to accomplish all those things from working from home. All that innovation, all those positive externalities when you go to and work in an office, right? In my case, when I worked, I remember here coming to the center, I wasn't, all the things I've learned from my colleagues here at the center. All these things, all the innovation, when we talk about how are we going to do a presentation, a paper, that is kind of hindered and lost when you're not working in the office. So we saw this even before that. The process of high-tech employees working from home, doing business online will accelerate. We expect more silent offices in suburbs or in other cities with less density to prefer employees in central downtowns or higher density areas. All these patterns were observed during the pandemic, and was due to housing and affordability issues. A lot of companies were moving away from California and New York, looking for their work, especially in Austin. You saw that from California to Austin because of the affordability issues for their workers. So let me show you the hard data now. So we created here at the center, working with Dallas Fed, a joint product of, we produced a residential leading indicator, coincident indicator. As you can see the graph, the black line, you can see that rebound. So that shows you that residential activity is on the rebound, and you can expect more activity going forward. The coincident indicator is still going down. One of the reasons is because we use Dutch construction values for that indicator, and those values are still going down. But overall, you can would expect higher activity going forward. Now the permits. All the permits, residential permits, rebounded in June. You can see that these are Texas residential permits, and at the end of June, they rebounded. They rebounded. The reason for this was it was led by single-family permits. This is where the strong part of the rebound happened. The single-family construction permits are leading to that. Multifamily, on the contrasting single-family, continue to fall. And that shows you initially how the construction in multifamily has slowed down. It's been hurt by the pandemic in the short run. Now, this is really interesting. So we saw this even before COVID-19, after the Great Recession. You see this in Texas and other parts of the country. This is not a Texas issue. I'm going to show you Dallas-Fort Worth, but I can show you the same graph for Austin, for Houston, for San Antonio, for El Paso. What has happened? What happens is that the production pipeline for housing, for the lower price cohorts, for starter homes, in the case of Texas, especially for homes with a price tag below $200,000, is not there anymore. There's no lots developed for a home builder to come in and build the house at that price range. That's one of the major issues that's been holding back the supply of homes. People do want to buy a home, but they want to buy a home with a price tag below $300,000. And you see those constraints, that lack of law development. It's interesting because we saw before the pandemic hit, we saw the home builders trying to build more homes at that price range. But after the pandemic, we see again the decline at homes, at the availability of land at that price tag. So sales, the bright spot of the recovery. I think here in Texas and the US, the bright spot has been sales. Actually, right now, housing sales have recovered all their losses here in the state of Texas. They actually are in expansion mode here in the state of Texas. So that's been one of the bright spots. You had all the demand that was held up during the pandemic, lower interest rates, all of this, also who was affected from the pandemic wasn't people that had the opportunity to buy a home. And now we see that big rebound in housing sales. Now, this is really interesting. If I showed you, I'm showing you Houston also here right now, but I can show you Dallas-Fort Worth, Austin. The same graph would happen. Look at the composition of sales of homes by price range. Look what was happened through time. Look at the blue line. Look at the sales of the market share of home sales with a price range below $200,000. In June of 2011, it made up around 66% of the sales here in the state of Texas, in Houston. And now it only represents about 24%. And how the other price cohorts has that changed, right? You've seen an increase in the number of sales for those price cohorts, and especially for the $200,000 between $200,000 and $300,000, you see that how that now represents one of the biggest parts of the market share in Houston. But like I mentioned earlier, the same thing applies for Austin, Dallas-Fort Worth, for San Antonio. The same trend has been observed for this. How the composition has changed, and how that price with a price below $200,000 is basically gone. It doesn't exist. It basically doesn't exist here in the state of Texas, and even going forward, right? And this is a trend that accelerated even more due to the pandemic. And then you can see right away the rebound in all the different price sectors in sales. Now, what's happened? The major issue, the months of inventory. There's been a major issue here in the state of Texas after the recovery. We saw a strong recovery here in Texas, but again, going back to what I was saying before, is the lack of supply, especially for homes in the lower price cohorts. And you see, a normal market has 6 months of inventory. That would be a stable market. That's a dashed black line right there. But as you can see, even for the U.S., for Texas, the 4 major MSAs, 5 major metropolitan areas here in the state of Texas, you see that home inventories are at historical lows, right? Even declining. And that accelerated during the COVID-19, because you know what happened. A lot of people did not go out and show their homes. Now, if one thing can hinder the housing market going forward, its current recovery and expansion could be the lack of homes, the lack of supplies, the lack of months of inventory of homes available. That is one thing that can be a headwind going forward for the housing market. And again, by price cohort. If you look at by price cohort, look at the lower price cohorts. Look at the months of inventory. It's below 2 months. It's incredible. It's below 2 months of inventory. Basically, shows you the supply of homes at that price range, and how difficult it is for you want to purchase a home at that price to find a home at that price. Now, here at the center, we also estimated a repeat sales index based on the information we have. So this is the repeat sales housing price index that we estimate here at the center. As you can see, the prices kind of slowed down, right, going forward. Texas did see an increase, and also Fort Worth, but overall prices have kind of slowed down after the pandemic. But still, they're increasing, right? Now, for us, Austin is here in the state of Texas, the city with the highest home prices, given its growth. It's been Austin. Now, mortgage rates continue to fall. That's one of the benefit of the housing market as inflation and growth expectations decline, right? Now, those falling interest rates, that slower price growth has benefited affordability here in the state of Texas. This is our own housing affordability index that looks at the capability of purchasing a home, and as you can see, has increased. The loan, the down payment, the ratio of that has increased, making it more affordable currently. Now, let's talk about multifamily, the effects of multifamily. This is a cool graph. It has all the 25 MSAs here in the state of Texas. You have the change in rents, the change in occupancy, and you can see that how they're more to the left, right? More to that negative quadrant where the change in occupancy has declined, vacancy increasing, and also you've started to see the percentage changes in rent declining, right? More negative rents. Now, if you see that big outlier, Midland, Odessa, it's been hurt. It's one of the MSAs that's been hurt the most. Why? Because of its dependence and on the oil industry. Basically, it's a one-trick pony city, a region that depends a lot on energy, and for them, they've been hit really hard because of the downturn in the oil industry market. Now, I mentioned to you earlier, what would you expect going up? COVID-19 effects. Well, here's the overall apartments for the city of Austin. Again, if I showed you Austin, Dallas-Fort Worth, Houston, San Antonio, you would observe the same trend, right? Now, what we did in the center, we did something cool here at the center also. We estimated natural vacancy rates. The same way we estimated a long time ago, using the same methodology that my colleague Alianari used to estimate the 6 months of inventory for the housing market. We did the same thing for all 4 major MSAs and for all the 3 different sectors: office, retail, and office. And also we did it for the apartment market. So that gray line is the natural vacancy rate for the overall Austin overall apartment sector. So again, what would you expect with the COVID-19? You saw vacancy rates increasing in the second quarter of 2020, and you saw how effective rents have declined. And you see now how you're above that natural vacancy rate, putting more pressure down on rents. Now here we have the net absorption for Houston overall apartment, and we saw, before COVID-19, how overall apartment in Houston was doing well, demand was doing well, right? Net absorption basically is the change in occupied space, the space occupied minus the space vacated. Basically measures demand. If you look at it now, the last quarter of second quarter of 2020, you see that negative downturn, and you also saw how construction has fallen, like I showed you also before that with permits. How construction has fallen for multifamily. And the same trend, if I showed you the other cities, you practically see the same trend also. Now, how about Class A apartments? So Class A apartments, different than overall apartments, because different outcomes, different market, different people rent Class A apartments. People with higher incomes, right? They're basically maybe not working in leisure hospitality, right, sector. So you can see right away, net absorption did decline, the demand declined, but continues to be positive for Class A, although overall construction continues to fall. Now, we also created a leading indicator for a quasi indicator and a leading indicator for non-residential construction. And if you look at the black line, you can see actually the leading indicator points to slower activity going forward. And the non-residential, the coincident indicator, the blue line, and the red line for Texas, the red line for the US, actually shows that rebound in non-residential construction. Here you have to make it clear. Now let's talk about office. Again, I'm talking about Austin. I'm putting Austin because Austin was one of the hottest markets here in the States with Dallas-Fort Worth. And again, vacancy rates increase and asking rates remain positive. So you can see again, we have that national vacancy rate. And you can see it. Even with the COVID-19 effect, you saw that asking rent growth for overall office in Austin, it actually declined, kind of stabilized. It remained positive. While yes, we saw that increase in vacancy in Austin. Now, Houston, talking about trends that accelerated because of COVID-19. Houston was, especially office, was not doing well, even before COVID-19. Why? Because of the oil downturn at the end of 2014 that brought back, and then continued in 2015, that caused, the Houston office market to be hit really hard. Now, with COVID-19, you saw again, the trend, the negative demand, the net absorption, and the fall in construction for Houston overall office net absorption. Now, how about Dallas-Fort Worth? Dallas-Fort Worth market was doing well, but even before COVID-19, we saw kind of slowdown in demand for Dallas-Fort Worth Class A office space, and then of course with COVID-19 effects, that was a greater hit for Dallas-Fort Worth, as you know, employment falls. So how about retail? So again, talking about Austin, we saw Austin market, was doing positive, demand was strong, and then we actually saw a decline in demand going forward as employment fell. I believe I jumped a slide. Let me go back real fast. Sorry about that. Okay, now not everybody was hit as badly as other parts. Houston, it's interesting to see Houston office was not doing well. The vacancy, even with the downturn, the retail sector in Houston was doing well. Again, you can see you still asking rent growth became positive. It went down due to the downturn. It went positive and is now slowing down. Vacancy also increased. I'm talking about Austin. So now, a sector that's been doing really well has been warehouse. Warehouse would have been actually benefited and less affected than the other two sectors in retail and office. As you can see right away, look at the vacancy rate. The vacancy rate for warehouse in Houston, and again, if I showed you San Antonio, the same trend you would see. Dallas-Fort Worth, Austin also increased. You can see how the vacancy rate is decreasing, and you have positive asking rent growth. Again, the benefits of the e-commerce, the look for distribution centers, local distribution centers, that's benefit the warehouse sector. So one sector that's benefited here during the COVID-19 has been warehouse, and we saw that process even before COVID-19. San Antonio, again, San Antonio was actually negative net absorption, right? We saw negative demand, and now actually we had a positive increase in demand for warehousing in the city in the MSA of San Antonio. Sorry. So again, going forward, what's going to happen? So the path to recovery depends on COVID-19 outcomes. Economic recovery could be hindered going forward by possible upsurges in COVID-19 cases. Further waves of infection can reverse increased mobility, spending, affecting the path to recovery. What we expect? Again, the short run, going forward, housing market, the star sector is doing well. The housing market, we're going to see still characterized by low inventories, accompanied by positive price growth. Here, the issue is, can there be more supply for housing? People do still want to purchase a home, but can we see that, right? Because that's going to hinder going forward if that expansion, the strength of that expansion continues or slows down. In the short run, apartment market outlook is worrisome due to the uncertainty surrounding people losing extra unemployment benefits. So we don't know how is that going to play out totally. If the federal government comes in and continues the some help, that would help the outlook for the apartment market. But right now it's uncertainty, and they're continuing to discuss what's going to happen forward policy-wise in Washington. Now, office, currently weaker demand. We see weaker demand. This is resistance for some sectors, as I mentioned. Definitely negative outlook for Houston, office market, and it started before COVID-19. Now, the retail restructuring is going to continue, benefiting warehouses while hurting retail. But retail, I think physical retail will still continue to be there. But I think the major winner is going to be the warehousing and the distribution centers. Thank you very much. That's the end of my presentation.
Thank you, Luis. That was great. We've had a number of questions that were submitted in advance when people registered for the conference. So I'll remind everybody that we're trying to go till about the top of the hour. If you have some questions for Dr. Torres, please put them in the chat. and we'll get to them. I'll scroll through them and moderate them. But I thought I'd start with a couple of questions themed together. There seems to be a lot of interest in the concept of migration from larger markets to smaller ones in response to COVID. And you mentioned the hybrid nature of some of the data that you're seeing in these markets. But we had a couple of questions about whether you're seeing any evidence that people are fleeing larger metros to more suburban, exurban, or rural areas as a result of COVID. Any evidence of that yet?
Not yet. We haven't. Great question, by the way. We actually discussed that here at the center. We have meetings every week, and we kind of have a little roundtable also. And we were discussing that, but currently there hasn't. We've heard the comments. Some people have said that, but we haven't. The actual data we haven't seen that yet. What's interesting that with Charlie, my colleague that looks at rural land data, what he did see is that uptick in rural land purchases. So maybe that is kind of like indicator of what people are talking about. But the data, the current data hasn't shown that movement still. Of course, also it lags, right? The data is lagging behind, like the migration data, all that information. So that's an issue going forward. But yeah, going forward, it's something we're definitely going to look here at the center as more data comes in.
Great. Well, related to that is this idea of the evolution of workspace and its effects on commercial startups and commercial rents, near term and long term. We had a question about that submitted in advance too. Are you seeing anything that you could characterize as a trend in the evolution of how we think about workspaces? You mentioned this hybrid workspace where people need some things from the formal office, but not other things. Anything catching your attention there?
Yeah, I think it is. I think that idea, that hybrid idea, that you're gonna want that because again, you don't want to lose completely the office. I think the idea of not coming, there's so much the externalities, the positive externalities, of the office of innovation, of discussing, of learning and everything when you have that environment. But also, I think people also, what we got from the COVID-19, a lot of people that we talk about is also the flexibility. I think also a lot of people like the idea of coming into the office and working, meeting with your colleagues, discussing, coming in a couple hours and maybe saying, today I'm going to work from the office, from my home, right? I think that's a trend I think is going to be imprinted in us. I think office is not going to go away. I don't think it's completely going to go away. I was listening to somebody from CBRE mentioning they did a survey, and before pre-COVID, they said that they saw that 65% of the people of the workforce actually had to work all day in their office, 65, something like that. And then after that, they would say that in 2030, they were saying it was going to drop to 52% or something. But now they're saying that maybe they've heard that 25% of the people are going to actually work a full day in their office, right? Every day they're going to come in and 25% of the workforce is going to do that. So I can see the in between with that. I can see you coming in, working day, but I can see now that flexibility, that hybrid, and more space, less a clustering of people, right? But I see that, in my case now, it'd be different because I like that flexibility. Of course, what we also saw is that people don't want to work from home all the time also. I don't know if that happened to you, Bruce. Especially, I heard, especially if you're a woman, I heard like all these executives on Bloomberg and everything talking about, when you see my colleagues here right now on Bloomberg or everything, the little boy comes in, everybody's, so cute, little boy, you put him here. But when it's a mom and the girl comes in, hey mom, where's my where's my unicorn backpack? I can't find this. My brother's, man, my brother's teasing me, everything. For women, it's been even harder, right? Because of the importance they have in the family, So not everybody wants to work from home or wants to, but I think the flexibility now, that hybrid idea, I think it's more into us right now than after the pandemic.
Related to this issue of migration, but from a different aspect, we had a question about whether you think Texas would continue to be a net migration beneficiary among the states.
I would say yes. I think
Nothing about the COVID situation is going to change that.
No, and especially, we have more space, right? Still, we're cheaper, relatively cheaper than other places. Regulation. I mentioned this before this. What's been affecting New York and California more than has been the taxes. I think the changes in taxes, the tax burden is heavier over there. The cost of doing business, the regulation of those states compared to Texas and other states. We still have those benefits. As people don't know this. Tesla just announced a couple of weeks ago, where you live, your neck of the Wilkes Bruce is moving its plant, starting his new plant there in Austin. I still see those benefits of people moving to Texas, that migration, that net positive migration.
Good. Well, no discussion about Texas would be complete without a further in-depth comment from you about oil prices. We had a question about whether you think there'd be a long-term oil price rebound, and if so, what's likely to underpin that rebound? What's it going to take to stabilize oil prices in Texas?
So here it depends on the U.S. economy and world economy, demand supply, right? Supply right now is, the supply is there. The problem here has been the demand, right? The demand, with the shutdown and everything, the U.S., the world economy, a lot of economies are currently in recession. Well, I would say the world economy, except in China, some Asian countries, are not in recession, but the rest of the world is in recession. So going forward, I've talked, seen the data and everything. I especially based on, I'll talk to Bill Gilmer. He's does a great job for Houston and for the oil industry. And we're discussing it, and we're talking about this specifically issue. And he was telling me that he was seeing, going forward, that maybe, you can see oil prices kind of increasing a little bit more in 2021 or the end of 2021 or 2022. Also discussions here with my colleagues, Hal Hunt. He's more of the oil expert here in the center. He follows the oil industry. So again, I think it depends, it depends on how fast and how strong can we recover from this, and how its demand can recover, and how mobility, right now. Still, if you look at the mobility data, all these new cool mobility data we're using, that high frequency data a lot of people are using now, it's still below, right? We're not going back to our normal, we're not traveling as much. We're still staying at home. When we go out and purchase something, right? It's like we know what we're going to do, right? Not before, like we went out and like, let's go to the mall and walk around, right? And see things. Now I have to pick up this precisely thing, right? Traveling has not come back yet. Also, so we have all these things still affecting the demand of it. And here again, it depends on the economy recovery, right? Making it full the path, the strength of the recovery. And that would allow the oil industry to come back. I wouldn't see $100 oil a barrel, right? Of course, right? But some maybe above $50, close to $60 a barrel.
Yeah, and I would say related to that, seeing Midland, Odessa out there on that far left-hand corner of the occupancy and the price collapse of the apartment market was startling. But I also saw that in your data, the Houston apartment and commercial markets tailing off, and accompanied by a reduction in job growth down in Houston. So yes, unless that market turns around, it's going to start affecting other major metros and not just the oil patches themselves. Of course, the oil is a little bit dispersed in Texas, not just the Permian. So up in that North Texas area, down south of San Antonio, there could be lingering effects as the price fails to bust out over 40.
Yeah, correct. Oh yeah, Houston. Just to add something, Houston has the number of. We also tracked the number of unemployment claims by MSA, and Houston those 22 weeks I mentioned, since the pandemic started, has recorded the highest number of initial unemployment claims than any other MSA in the state. And you would expect that, right? Because Houston was hit by a double whammy. The importance in Houston of the oil industry compared to Austin, Dallas-Fort Worth, or even San Antonio, so it's hurting right now, right? A little bit more than the rest of the MSAs.
Here's a question about the affordable housing. Do you think that something will fill the gap between demand for housing below 300,000 and the supply and construction of housing in the price range? So
before COVID-19 hit, we did saw some indications, some data that home builders were trying to build homes at that price. Maybe smaller homes, no smaller plot, but they were trying to do, and you would see, if you look at the other, like some of the price ranges on here, but other MSAs, you saw an increase. And we're trying to do that, but once this hit, again, we saw that downturn. Now, here's a major issue, Here is where, the housing market. We've tried to look here at the center also at manufacturing housing, the new technologies. I think people still think about mobile homes like your grandfather's mobile home, right? They're all bad. They're like, oh my God, no, the new technology is impressive. I've seen the new manufactured homes, and if the person wouldn't have told me this is a manufactured home, I would have not known. They don't squeak and everything. Here's an opportunity. I don't know if it's going to happen or not because we haven't done it in the past, but it's an opportunity now to try to include more manufacturing home parts into the home building processes. I think there's a great opportunity going forward. With the new technology, the way they do it, the high quality of it, to save lower costs and try to build homes at that price range, right? Because now we're facing that big issue that there's no homes at that price range. Not even here, well, here in Texas and California and other states, right? It's not just a Texas issue.
Yeah, great point. And related to that, we had a question about multifamily homes and the affordability issue. The question is, it seems like affordability will become more of an issue if multifamily comes to a halt because of collections and price, and this would leading necessarily to a shortage of comparatively affordable housing. Is this multifamily collapse of new home construction an issue for you?
Well, again, people need a place to live, right? In the short run, it's going to affect the supply of multifamily. But, if the demand is there for Class B or Class C apartments, more affordable apartments, if it's there, I think the home builder is going to come back and build. Right now, with the issues, with the uncertainty of all these people, what's going to happen? The help they were getting, it's stopped, right? They're not getting those extra $600 anymore, right? So what's going to happen? And the other thing I can mention also, you don't have the options of finding a job also. A lot of those jobs that they had are not there anymore. So I think I think it depends on policy, federal policy. What's the policy going to do? We could have a big issue there if we don't find the correct policy or continue the same policy or figure out what we're going to do going forward. Because if not, it can cascade, right? Imagine the people that have a mortgage, the investor or the developer who has a mortgage and can't pay his mortgage. Well, that's going to affect. It's going to be a domino effect going forward. He's not going to be able to build new apartments going forward because he had a bad experience. He just lost his building, his apartment, his multifamily. Of course, he's not going to get another loan going forward. So right now, I think the question is the fiscal policy and those policies that we saw that were enacted. Actually, they did help because I think in prior recessions, if you look at prior recessions, there was always a fall in income, right? In this case, we didn't see that fall in income. Why? Because we saw the help of the federal government. That extra check that they sent us, the $600, those transfer payments they gave us. But now, going forward, what's going to happen? Right?
Yeah. So speaking of policy, I'd be remiss as moderator if I didn't ask you about the political angle of the policy options for the real estate market. With the election coming up, do you see a set of policies in the Trump camp or the Biden camp that might be more or less beneficial to the real estate sector, depending on the outcome of the election?
So again, it depends on regulation, right? On regulations and taxes. I don't know. I haven't seen, I don't. First of all, I don't think he has a sign who's going to be his. I don't know who Biden's economic advisor is. I know what type of policies, what I've heard. But again, for me, what's going to happen going forward is going to be if there's going to be more regulation. What type of taxes are they going to have? Because I've heard that the Biden has the idea of implementing more taxes, but what type of taxes? So what type of regulation? I think that's the things we have to look at going forward to see what's going to be the impact on real estate.
Well, great. Luis, I thank you so much for spending this hour with us, and I think we'll leave it there. We're approaching the top of the hour. I appreciate your time, and thanks to everybody who spent the hour along with us here in these AUBER webinars. This is the last one before our fall conference, so please check our website for how to register, and we'll see you in September.
Thank you.
Bye-bye, everybody. Thank you.
Be safe.